Hi, thank you for watching Dig Into China. I'm Dong Sean. If you have not done so already, please subscribe to my channel. Thank you very much. In 2024, the Chinese Communist Party creates a significant insurance pit for the entire Chinese population. It is strongly advised not to venture into it. Insiders within China's insurance and banking sectors have disclosed that this year, the central government has instructed them to invest 50% of insurance funds in the stock market. Additionally, the retail divisions of banks are urged to generate the profits mainly through the sale of insurance products. Given the recent announcement by the China Securities Regulatory Commission about encouraging long-term funds like Social Security and insurance funds to enter the stock market, it becomes apparent that the Chinese Communist Party has new plans for this year. Aside from relying on the Social Security Fund and insurance funds, it appears that the Chinese Communist Party is facing a challenge in identifying alternative funding to support the stock market. Some Chinese individuals may assert, "I won't purchase insurance, and no matter how banks try to persuade me, I won't buy. If I avoid buying insurance, I won't fall into the pit," correct? However, the reality is more complex. Insurance serves as just the beginning, with a subsequent series of interlinked traps to navigate. In late December, there was a news item that didn't draw much attention from many people. Several insurance companies were making efforts to issue perpetual bonds. What exactly do perpetual bonds entail? Perpetual bonds are a type of bond with no maturity date. Unlike conventional bonds that have a fixed maturity date when the principal is repaid, perpetual bonds do not have a specific maturity date. Investors receive periodic interest payments indefinitely, and the principal amount is not repaid. Perpetual bonds are often issued by governments and corporations as a means of raising capital. While they offer the advantage of not requiring repayment of the principal, they also typically have higher coupon rates to compensate investors for the lack of a maturity date. Some perpetual bonds may have features that allow the issuer to redeem the bonds under certain conditions. Since November, 4 insurance companies, Taikon Life Insurance, China Pacific Insurance, ABC Life, and the People's Insurance Company of China have formally launched perpetual bonds. So, why the sudden focus on perpetual bond issuance by insurance companies? The main objective is to bolster their core capital. However, what has led to a deficiency in core capital? There are 3 potential reasons for this. In the first scenario, the funds raised by insurance companies are earmarked for investments. Unfortunately, substantial investment losses over the past few years have eroded the insurers' solvency, prompting the need to bolster their core capital. In the second scenario, insurance companies are gearing up to expand their operations in 2024, intending to establish branches in more cities. This ambitious expansion plan calls for additional capital. The third potential scenario involves large insurance companies taking on the responsibility to rescuing smaller insurers that have gone bankrupt. Examples include Evergrande Life from Evergrande Group, Huaxia Life from Tomorrow Holdings, and several others like Tian'an and Yi'an, which are facing insolvency. Currently, over 30 Chinese insurance companies are reported to be operating at a loss. According to industry regulations, while insurance companies can go bankrupt, their policies must be transferred to other insurers. Hence, if major insurance companies are set to take over the policies of these smaller insurers, it's likely that additional capital will be required. Currently, the issuance of bonds by major insurance companies to supplement the core capital may be driven by the 3 reasons mentioned earlier. I believe all 3 factors are in play, and this is closely tied to the financial strategy of the Chinese Communist Party this year. Given Emperor Xi Jinping's relatively limited knowledge in finance, the strategies employed under his direct guidance becomes more predictable. To begin with, this year, Xi Jinping aims to uplift the A-share market. How does he plan to achieve this? Firstly, through insurance. He mandated that 50% of insurance funds be invested in the stock market. Secondly, through individual pension funds. Since last year, bank employees across China have been actively opening individual pension accounts, indicating a clear top-down imposition of mandatory targets. What's the objective? It's because the Chinese Communist Party intends to utilize funds from individual pension accounts to address deficiencies in the stock market. There is also a third element, increasing the proportion of funds from Social Security entering the market. Actually, the clues of these 3 points were already evident in the statements made by the China Securities Regulatory Commission last year. The CSRC emphasized the need to channel long-term funds into the stock market, particularly focusing on insurance funds and the Social Security funds. Hence, the conclusions I have drawn today are not without a basis. They are supported by this regulatory context. So, the funds for entering the A-share market have been identified by the authorities. The next strategic move, in my opinion, will involve stringent control over various cash-out activities, such as restricting private placements and prohibiting major shareholders from reducing their holdings. I anticipate these measures will be rigorously enforced in the short term. Why? The objective is clear: to induce a bullish trend in the A-share market, possibly reaching 3,100 points or 3,200 points. This will be accompanied by a chorus of optimistic voices from both the public and officials, creating an illusion of a bull market. At this juncture, the trap is set, awaiting Chinese investors to jump in. Once the stage is set, fund companies are likely to release a number of new funds for sale to the public, enticing ordinary citizens to become the bag holders. When the signal is given, the authorities will initiate market drainage, causing stock prices to plummet rapidly, potentially dropping below 3,000 points. However, major state-owned enterprises will have already amassed substantial funds during this market hype, enabling them to address the financial gaps of local debt platforms. Remarkably, the local debt crisis is deftly averted. What are your thoughts on this strategy employed by the authorities? It might seem rudimentary, but it serves its purpose. So, coming back to the insurance sector, it is set to play a pivotal role in the significant harvest of individual investors in the Emperor's plan this year. To begin with, insurance companies are mandated to invest 50% of their insurance funds in the stock market, serving the purpose of enhancing the Emperor Xi's image. However, this strategy is anticipated to result in losses, hence the requirement for additional capital, correct? Secondly, given the surplus of personal deposit in banks, insurance companies are tasked with the responsibility of enticing individuals to withdraw their savings. Within the country, beyond simply depositing money, the investment options available to the general population are rather limited, encompassing wealth management products, mutual funds, and insurance. In the past few years, many financial products have faced losses, gradually losing appeal. Mutual funds too have suffered from a diminished reputation. And without a thriving market, attracting investors has become a challenge. Hence, upon closer examination, is insurance emerging as the final choice? For those acquainted with insurance, it's evident that insurance companies primarily sell their products through persuasion. The focal point of this persuasion is not to convince you that insurance is a lucrative investment, but rather to encourage you to contemplate it from a protective standpoint. Drawing from personal experience, many years ago I sold life insurance and have a first-hand understanding of the emotional aspect involved. For instance, when promoting life insurance, the emphasis often revolves around unexpected life events as the potential sole or primary provider for your family, responsible for both elders and the children. The pitch revolves around the notion of safeguarding your family in the event of unforeseen circumstances. If you are currently 30 years old, assuming you work until retirement at 60, earning 100,000 yuan a year amounts to 3 million over 30 years. However, if an unforeseen event occurs, how would your family manage without the 3 million they would have depended on? Therefore, the suggestion is to secure a 3 million life insurance policy for the benefit of your family and find a peace of mind in the process. Unless one chooses to buy term life insurance with lower premiums, which is a straightforward life insurance option. The typical life insurance in China combines investment with insurance. If one does not pass away within a specified period, the paid premiums are considered as investments with potential returns. However, insurance companies generally avoid calculating the specific returns because doing so would likely reveal a loss. It is more advantageous to invest in the same amount without deducting insurance premiums when engaging in regular investments. Insurance funds come with a long-term commitment. Once you've invested, it's a prolonged commitment, unlike wealth management products that can be cashed out in a few months or a year, or mutual funds that offer daily redemptions. Insurance is a one-time transaction, and if regret sets in, the financial losses can be substantial. Considering all factors, the cost of funds attracted by insurance is the lowest. Investors in insurance in China are perceived as high quality. Hence, the primary focus this year is on a nationwide promotion of insurance sales. Insiders in the banking industry indicate that the direction for the retail banking sector this year is primarily centered around selling insurance to generate intermediary income. It's important to understand that the insurance products specifically designed for banks represent a lucrative opportunity for financial institutions. Depending on the particular product, banks can earn a commission ranging from 10% to 20% of your insurance premium. This translates to a substantial profit, allowing banks to pocket 1,000 to 2,000 yuan if your insurance premium amounts to 10,000 yuan. Given the substantial profit pressures faced by banks, they are inclined to prioritize business ventures that promise higher returns. Consequently, this year is likely to witness a frequent occurrence of news where seemingly routine banking transactions such as depositing money unexpectedly involve insurance products. The A-share market boasts 5 listed insurance companies: China Life Insurance, China Pacific Insurance, New China Life Insurance, China Reinsurance, and the Ping An Insurance of China. Among them, China Life Insurance stands out as the least favorable. Despite being a state-owned enterprise, it is perceived as one of the most aggressive in exploiting investors. Referencing the financial reports for the first 3 quarters of 2023 reveals that among the 5 listed companies, China Life Insurance demonstrated the weakest net profit performance, witnessing a significant year-on-year decline of 48%. Why is China Life Insurance the least profitable among insurance companies? The reason is straightforward: being a state-owned enterprise. Its primary objective is to exploit investors rather than focus on profitability. China Life Insurance predominantly offers participating insurance policies, which involves annual dividend distributions based on the company's discretion. In 2022, among the 105 participating insurance products offered by China Life Insurance, only 1 exceeded the illustrated dividend provided by the company. The remaining 104 products did not meet the standard dividend rates. Those familiar with purchasing such insurance are acquainted with the sales pitch. The insurance company presents a demonstration chart, essentially a model, illustrating 3 tiers of individuals: high, medium, and low. However, this is merely a model, a calculation made by the insurance company itself. Surprisingly, out of the 105 products China Life Insurance released, only 1 exceeded the illustrated returns, while the rest fell short. Such a performance is rather disappointing. Please be mindful that when insurance companies tout dividend insurance policies, the annual dividends they promise are not determined by their genuine financial performance, but rather by their sense of responsibility. It is clear that China Life Insurance stands out as one of the less scrupulous among all insurance companies, especially considering its status as a state-owned enterprise. Therefore, it is imperative for everyone to discern the true nature of these institutions. They all serve the Communist Party. And in their perspective, you are merely seen as a resource to be exploited. Among the 5 A-share listed insurance companies, Ping An Insurance boasts the most favorable financial data and holds the unique position of being the only private enterprise among them. Despite facing its own set of challenges, Ping An Insurance stands out positively compared to its state-owned counterparts in terms of operational performance. In the future, there may be an opportunity to provide a more in-depth analysis of Ping An Insurance. In summary, this year, Xi Jinping has orchestrated a financial plan for the entire Chinese population, with insurance as the centerpiece. Due to the emperor's limited financial knowledge, the strategy appears transparent and akin to a deceptive investment scheme. The approach involves initially inflating the stock market using social security funds, personal pension funds, and insurance funds to create a false sense of an impending bull market. Subsequently, through media manipulation and collaboration with banks and insurance companies, the public is lured into investing their savings in stock funds and insurance. Ultimately, Xi Jinping withdraws liquidity from the stock market, leading to the loss of people's savings, declines in funds, and entanglements in insurance, while simultaneously addressing a significant portion of the emperor's local debt problem. In the coming year, there is a high probability that the Chinese people will initially encounter sales pitches for insurance, followed by recommendations to invest in mutual funds. Subsequently, you may face substantial losses in your personal pension funds, and your savings could unexpectedly be converted into insurance. These are pitfalls that many might come across, so it's recommended to steer clear of them. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.